What is up, everybody? Welcome back to Bitcoin and Markets. My name is Ansel Lindner, and it is FOMC day. So we are going to react to the FOMC drop. I went over it already with the guys on Telegram. The Fed decided to hold rates steady. Let's go in here and look at this announcement. So for you guys, if you want to find it, you can just Google FOMC calendar, and you go to this page and they'll have it for the meeting. You can look at it in different formats. I just, of course, do the HTML, and you can get their boilerplate, semi-boilerplate this week. There's a few changes that we can go over, but they held their rates steady at 5.25% to 5.5%, and they also left their QT as described in previous plans. So they didn't change anything as in regards to the policy rate or QT. There was a few different tweaks to the language. So recent indicators, economic activity is a strong pace in the third quarter because we did get the GDP at 4.9%. Tighter financial conditions and credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. That is something new. And, their monetary policy is not necessarily moving the policy rate. I mean, it is if that is how they want to signal, or they can signal by things like that, saying that by them saying tighter financial conditions and credit conditions, they are signaling what they want you to believe about the economy. So anyway, what I want to do on this live stream is watch the press conference, and let's go into that. So this is the YouTube video, and it is, let's go to the
responsibility
live.
of the Federal
We better
Reserve.
rewind
Without
here.
price stability, the economy.
Here we go. Sorry about that. I'm going to share my screen with Telegram so you guys can see it and hear it. Here we go.
Good afternoon, everyone. Welcome. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks.
Okay, let's really quick take a look at the Federal Reserve balance sheet. So we can see this is their QT that they're doing, and it is coming down quite rapidly. So we had this hiccup there in March with all the different lending programs that they have to save the banks in March, and it has been coming down. Now it's under 8 trillion at 7.9 trillion. We can also take a look at the reverse repo. And this is one that I've been trying to watch closely because it is coming down very quickly. The top was at 2.5 trillion in their overnight repurchase agreements that they were doing. That is where the banks or primary dealers or approved entities can bring cash to the Fed and get treasuries in return. Okay. And that was at 2.5 trillion, and now it is down to 1.1 trillion. It has definitely come down quite a bit. All right, let's go back to Powell.
We face, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I'll have more to say about monetary policy after briefly reviewing
Isn't it interesting that, well, let me get to a
economic development.
better image of him. So isn't it interesting that with all of these PhDs, and all of this incoming data, and thinking that they're quantitative, they end up doing nothing. And when they do raise rates, they raise it by a nice round quarter percentage point. And they do QT at a nice round 80 billion a month or 40 billion a month, whatever it is. It's like all these round numbers, like the PhDs couldn't come up with, 37 billion a month is the perfect number, quantitative number, versus 40. Or we need to raise by 18 basis points instead of 25. Whatever the case is. Maybe this time they could have cut by 10 basis points instead of leaving it steady, right? Like all of these PhDs and all this quantitative analysis and all this data, and they do absolutely nothing. I mean, it's just kind of amazing.
Developments. Recent indicators suggest that economic activity has been expanding at a strong pace and well above earlier expectations.
Sorry to keep breaking in, but this is just an example of what the whole thing is about. The whole thing is not necessarily about what is the rate, what is the policy rate. The whole thing is about how do we signal. So it takes all these PhDs to signal in the proper way. So take a Fed president that's on the FOMC, and they have this long history in banking. They probably have degrees from Harvard or Princeton. They're all these They have all these credentials, and then when they talk, it matters. It's a signal. So that's why they have all these PhDs, is to keep that signal at the highest possible signal, the most credibility, with the most PhDs and the most letters after your name. That is how you get a clear signal, or how you get a monetary policy transmission, through boosting the signal through letters behind your name. So that's why they need all the PhDs, not to keep rates steady. They don't need PhDs to keep rates steady.
In the third quarter, real GDP is estimated to have risen an outsized annual rate of 4.9%, boosted by a surge in consumer spending. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance.
Okay, one thing I wanted to say about the GDP, yes, it came in at 4.9%, and it was actually relatively solid. I covered this with Telegram when I did the live drop at 2 o'clock. But GDP didn't have any funny math. I mean, I was expecting some import-export math to make it look like it was that high. It actually was quite strong. Consumer spending was quite strong. Investment was quite strong. However, it was not strong enough to break us out of the downward trend. So the downward trend is intact. The one number in there that stood out was disposable income came in slowing. So we have slowing bank credit, contracting bank credit, increasing debt levels, increasing personal, or decreasing personal savings. People are spending through their savings, and a decrease in personal income. That is a bad omen for the future. Most likely, Q4 GDP will be much slower than 4.9. We could go down to 2% or 1%, something like that. But overall, it was a good print in GDP, but not enough to get us out of the downward trend. Okay, let's continue.
Over the past 3 months, payroll job gains averaged 266,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.8%. Strong job creation has been accompanied by an increase in the supply of workers.
Something different that I just noticed, usually he has his book in front of him, and or at least the transcript, and he's reading that, but it looks like he's reading from a teleprompter this time.
The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years, and immigration has rebounded to pre-pandemic levels. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation remains well above our...
But not for high-paying jobs. Those are for the low-paying jobs. They can't find people. They can't find good help for low-paying jobs, but they can. It's very hard for people to find the high-paying jobs and to get paid a fair market wage for a lot of things out there.
Longer run goal of 2%. Total PCE prices rose 3.4% over the 12 months ending in September. Excluding the volatile food and energy categories, core PCE prices rose 3.7%. Inflation has moderated since the middle of last year, and readings over the summer were quite favorable. But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate.
So he's probably talking about the University of Michigan survey that did have a little brief jump. That is for inflation expectations. And also we have the 5-year forward. Let's just bring this up. This is 5-year forward inflation expectation rate. So basically it's taking an expectation, a market-derived expectation for the window that starts in 5 years and runs to 10 years. That is a long-term inflation expectation in the economy. And you can see it's been relatively flat, kind of maybe going up a little bit here this year, but not higher than it has been in the past. And this is one thing that I looked at during COVID and was like, that's why this CPI thing is going to be transitory, because inflation expectations are not going higher. And if we zoom out to include the Great Financial Crisis, you can see back here in 2012, in 2011, 2010, all of these years, it gets higher than it ever got during COVID. We can look at other things like the 5-year break even. Let's do 10-year break even. This is the difference between TIPS and inflation protected securities and non-inflation protected securities. And for the 10-year, you can see it's 2.4% right here. So the long-term inflation expectations are continuing to be well anchored right there where they have been for a very long time. And if we zoom out on this one as well to the Great Financial Crisis, you can see, well, it's right in line. This one's more in line with post-GFC. But pre-GFC, it was consistently at 2.5 or even higher. So it was consistently higher than it is today. Let's zoom out a little bit more. 2.5, even up to 2.75 here back in like 2004. So this is well anchored. This is what the market has. It's normal. It's normal. And I've been calling for a post-GFC normal, a return to post-GFC normal. That wouldn't be like these up here at 2.5, actually. I would call post-GFC normal starting in 2013, 2014, and going to 2019. That would be like a post-GFC normal that I'm looking at around 2% for inflation expectations from the break even and from the 5-year forward. Okay, let's get back to Powell.
Employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we are confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor.
So that the inflation rate, or the CPI, is consistently or confidently, how did he put it, on the path. So if they see recession coming in 6 months, they'll cut or they'll do something about it. And that's Powell's MO. I mean, I don't know. I haven't really thought about this too much about this type of language here. But yeah, just the thought process when he said that, that they will continue on this road until they're confident of the path of lower interest rates or lower inflation rates, then like he did in 2019, he will do a preemptive cut. That's interesting. We'll have to talk about that more.
Evidence of growth persistently above potential, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. Financial conditions have tightened significantly in recent months, driven by higher, longer-term bond yields, among other factors. Because persistent changes in...
Okay, this is wrong. I mean, if you remember in interest rate fallacy, higher interest rates do not mean that things are tight. Higher interest rates actually mean that money is relatively loose in the economy. Now, we do have an interesting time right here that, like, the Chinese are having to sell a bunch of U.S. treasuries at the same time that the U.S. is pumping out a lot more treasuries. But overall, when rates are going up, it does not signal tightness. It does signal duration risk for banks, but it does not signal tightness of money in the economy.
And financial conditions can have implications for the path of monetary policy. We monitor financial developments closely. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook and for economic activity and inflation, as well as the balance of risks. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below potential growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Let's go to Howard.
Howard Schneider with Reuters. Thank you,
All right, this is the interesting stuff, the Q&A.
Chair Powell, for doing this. To what you referenced the rise in long-term bond yields, to what degree did that supplant action by the Fed at this meeting?
Thanks for your question. So I'll talk about bond yields, but I want to take a second and just sort of set the broader context in which we're looking at that. So if you look at the situation, let's look at the economy first. Inflation has been coming down, but it's still running well above our 2% target. The labor market has been rebalancing, but it's still very tight by many measures. GDP growth has been strong, although many forecasters are forecasting, and they have been forecasting, that it will slow. As for the committee, we are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. And we're not confident yet that we have achieved such a stance. So that is the broader context into which the strong economy and all the things I said, that's the context in which we're looking at this question of rates. So obviously we're monitoring, we're attentive to the increase in longer term yields, and which have contributed to a tightening of broader financial conditions since the summer. As I mentioned, persistent changes in broader financial conditions can have implications for the path of monetary policy. In this case, the tighter financial conditions we're seeing from higher long-term rates, but also from other sources like the stronger dollar and lower equity prices, could matter for future rate decisions as long as two conditions are satisfied. The first is that the tighter conditions would need to be persistent, and that is something that remains to be seen. But that's critical. If things are fluctuating back and forth, that's not what we're looking for. With financial conditions, we're looking for persistent changes that are material. The second thing is that the longer term rates that have moved up, they can't simply be a reflection of expected policy moves from us that we would then, that if we didn't follow through on them, then the rates would come back down. So, and I would say on that, it does not appear that an expectation of higher near-term policy rates is causing the increase in longer-term rates. So, in the meantime,
Okay, I want to kind of rewind that a little bit, and I want you guys to listen to this from the perspective that their policy is guidance. It is all about narrative, because this whole answer is not like, oh, when we raise rates, we need to do it because of this mechanical effect in the marketplace or yada, yada, yada. No, it's how will the market interpret it? Will the market front run me? Will it react to this thing or that? It has nothing to do with mechanics.
financial conditions can have implications for the path of monetary policy. In this case, the tighter financial conditions we're seeing from higher long-term rates, but also from other sources like the stronger dollar and lower equity prices, could matter for future rate decisions as long as two conditions are satisfied. The first is that the tighter conditions would need to be persistent, and that is something that remains to be seen. But that's critical. If things are fluctuating back and forth, that's not what we're looking for. With financial conditions, we're looking for persistent changes that are material. The second thing is that the longer-term rates that have moved up, they can't simply be a reflection of expected policy moves from us that we would then, that if we didn't follow through on them, then the rates would come back down. So, and I would say on that, it does not appear that an expectation of higher near-term policy rates is causing the increase in longer-term rates. So, in the meantime, though, perhaps the most important thing is that these higher Treasury yields are showing through to higher borrowing costs for households and businesses, and those higher costs are going to weigh on economic activity to the extent this tightening persists. And the mind's eye goes to the 8%, near 8% mortgage rate, which could have pretty significant effect on housing. So that's how I would answer your question.
Just as a quick follow-on, to be clear on this, in your opening statement and just now, you seem to imply that you are not yet confident that financial conditions are restrictive enough to finish the fight. Is that true?
Yes, that's exactly right. To say it a different way, we haven't made any decisions about future meetings. We have not made a determination, and I will say that we're not confident at this time that we've reached such a stance. We're not confident that we haven't. We're not confident that we have. And that is
Oh boy,
the
how
way we're going to be
wishy-washy
going
is
into
that?
these future meetings. is to be, just determining the extent of any additional further policy.
All those PhDs, and they're not. They can't say. I mean, it's just complete wishy-washy.
Tightening that may be appropriate to return inflation to 2% over time.
Gina.
Hi, Chair Powell. Thank you so much for taking our questions. I wonder, if you don't raise interest rates in December, would the presumption be that at that point that we should expect that rates are at their peak, or is there a possibility of restarting rate increases next year? And are there any costs to taking a more extended pause?
So let me start by saying we haven't made a decision about September. You're asking a hypothetical.
December.
But we're going into the December meeting. We'll get, as you know, 2 more inflation readings, 2 more labor market readings, some data on economic activity. And so we'll be taking, and also the broader situation, the broader financial conditions situation, and the broader world situation. We'll be looking at all those things as we make a decision in December. We haven't made that decision. I would say, though, that the idea that the idea that you would be difficult to raise again after stopping for a meeting or two is just not right. I mean, the committee will always do what it thinks is appropriate at the time. And again, we haven't made any decisions at all about December. We didn't talk about making a decision in December today. Really, it was a decision for this meeting and understanding broader things.
Nick.
All right.
Nick Timmeros of the Wall Street
Timmeros.
Journal. Chair Powell, did the Fed staff put a recession back into the baseline forecast in the materials for today's meeting? And how much does this tightening in financial conditions substitute for rate hikes if the tightening is persistent? You had said it was worth maybe a quarter point when we had the bank failures in the spring. What is it here on something that's presumably more straightforward and more familiar to simulate?
So I guess I don't want to answer your question about the recession, but the answer is no. I think I have to answer it since we did publicly say in the minutes. You'll know anyway in the minutes. The staff did not put a recession back in. I mean, it would be hard to see how you would do that if you look at the
What was
look
that?
at the activity we've seen
I
recently.
don't want to tell you, but I have to because it's in the minutes. It's going to be in the minutes. What kind of answer was that?
Which is not really indicative of a recession in the near term. In terms of how to think about translation into
Yeah, if rates are going up, guys, we are not headed towards recession right now. I just read a tweet from somebody. I don't know if they follow me or if I just follow them or whatever, but he was saying that, his outlook is if rates haven't peaked and aren't coming down, then there is no recession in the near term. So, yeah, this is people can just look at the charts and be like, what happens to rates right before a recession? Well, about 6 months to a year before recession, rates turn over, and we aren't seeing that. And this time is not going to be different.
rate hikes, I think it's just too early to be doing that. And the main reason is we just don't know how persistent this will be. You can see how volatile it is. Different kinds of news will affect the level of rates. And I think any kind of an estimate that was, precise would hang out there and have a great chance of looking wrong very quickly. So I think what we can say is that financial conditions have clearly tightened, and you can see that in the rates that consumers and households and businesses are paying now. And over time, that will have an effect. We just don't know how persistent it's going to be, and it's tough to try to translate that in a way that I'd be comfortable communicating into how many rate hikes that is.
If I could follow up, I guess what makes you confident that tighter financial conditions will slow above trend growth when 500 basis points of rate hikes, QT, and a minor banking crisis have not thus far?
That's a great question. Let's rewind it. Good old Nick Timmeros with the hard-hitting question.
What makes you confident that tighter financial conditions will slow above trend growth when 500 basis points of rate?
So just listen to that question. Above trend growth and tighter financial conditions, those don't really go together. You know what I mean? The reason why rates are high is because of the interest rate fallacy. money is actually loose right now, or it has been loose over the last year or so. That's why rates are going up. But the if 500 basis points hasn't slowed down growth, hasn't done the demand destruction that the Fed has wanted this whole time, what makes him confident that another 6 weeks is going to do it?
Rate hikes, QT, and a minor banking crisis have not thus far.
Well, I just that's the way our policy works is, and sometimes it works with lags.
That was not an approved question, Nick. You're not allowed to ask that one.
Of course, which can be long and variable, but ultimately, if you raise raise interest rates, you do see those effects, and you see those effects in the economy now. You see what's happening in the housing market. You're seeing that now. You'll see if you look at surveys of people, it's not a good time, they think, to buy durable goods of various kinds because rates are so high now. I mentioned again, we're getting reports from housing that the effects of this could be quite significant. But you're right. This has been a resilient economy, and it's, I think, been surprising in its resilience. And there are a number of possible reasons why that may be. Our job is to achieve maximum employment and price stability, and so we take the economy as it comes. It has been resilient, so we take it as it is.
So they look at everyone's raising their hand. They raised very, very quickly, 75 basis point hikes. I think they had 4 75 basis point hikes. People are going to look back and be like, well, should they have raised, a full percentage point at a couple of those? Should they have gone in with a different strategy, gone even faster? Because the economy isn't actually doing all that badly. We have GDP at 4.9% annualized. That is a very robust economy, like he's saying. So why he didn't even answer the question? Why does another 6 weeks matter? Why does another 3 months matter? You're not moving the interest rate, and it hasn't. Would you be willing to go to 10% to get this economy to start moving in the direction that you want? It was a great question.
Colby.
Thank you. Colby Smith with the Financial Times.
I don't know why all these people raise their hands, because they just go down the front row. All the guys in the front row get to ask the questions first. They should just pass the mic down. That's funny.
Of the thresholds that you've laid out of what could warrant further tightening, the additional evidence of persistently above trend growth or some kind of reversal in the recent easing of labor market tightness, that seems to suggest something more powerful than just one more quarter point rate hike would be necessary. And I'm just curious if that's how the committee sees it.
So we've identified those factors. Those were not meant to be the only factors or a specific test that we're going to be applying with some metrics behind it. Really, we're going to be looking at the broader picture and what's happening with our progress toward the 2% inflation goal. Is the labor market continuing to broadly cool off and achieve a better balance? We'll be looking at that. Growth, we look at growth insofar as it has implications for our 2 mandate goals. We look at that, and we look at broader financial conditions. So we'll be looking at all of those things as we reach a judgment, whether we need to further tighten policy. And if we do reach that judgment, then we will further tighten policy.
Okay. And just in terms of the tightening of financial conditions, if that is having some kind of offsetting effect in terms of the need to potentially, again, raise rates, what then is the potential impact on the trajectory of rate cuts? Could we see those maybe pulled forward or have to see more than what the September SEP indicated?
So the fact is, the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is, have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time, sustainably? That is the question we're focusing on. The next question, as you know, will be, for how long will we remain restrictive? Will policy remain restrictive? And what we said there is,
I think that they're doing themselves. They're doing themselves some damage here. So one of the things that they want is to keep confidence, that the Fed has the biggest stick and they can do whatever they want with the economy. If they raise 25 basis points, oh my God, it's going to be a drastic change. People have to have confidence. Don't fight the Fed. They have to believe in the mantra, don't fight the Fed. But if Powell gets out here, and I understand why he's being wishy-washy, why they will say we're going meeting by meeting. We don't know. We can't say yes or no. We can't say it looks good or looks bad. I don't want to answer your question about recession, but no, it's not in there. And the reason why he's doing that is so the market can't front run him. He's trying to let the market digest the actual market conditions and go from there. The problem is the more wishy-washy he is, and the closer we do get to recession, the more people are going to be like, well, the Fed, the whole time, Powell, you said you didn't know. You said you had 1,400 PhDs in the Fed and you did not see this recession coming. And you kept policy too restrictive for too long. They're setting themselves up for more loss of confidence. And this is spreading around the world. I mean, I don't know who has confidence in the ECB at this point or the BOJ. All the central banks are seemingly losing the confidence of the investing public. So I think little old me, who am I to make any sort of recommendation? But if I were to give one some advisement to these people, I would say you need to start putting some timelines on it. You need to say our goal is to stay restrictive until, and they do with the dot plots, okay? But they need to translate that into more actual language. Be like, we are at a restrictive rate right now. We know if we stay at this rate right here, everything will go the way we want it to. Okay. They need to be much more solid about their recommendations and their outlook for the economy. They can't say, oh, I think we are restrictive, or we don't know if we're too restrictive or not restrictive enough. No, he needs to start doing some concrete stuff and say, we are restrictive and it's going to be fine, blah, blah, blah. I think that's what the market is wanting right here. And actually, that would be extremely bullish for the U.S. economy if they did something like that. So anyway.
Is that we'll keep policy restrictive until we're confident that inflation is on a sustainable path down to 2%. That'll be the next question. But honestly,
we're confident that inflation is on a downward path. We're confident. Why don't they say that? They're going to lose this. I don't know.
Right now, we're really tightly focused on the first question. The question of rates cuts just doesn't come up because I think the first, it's so important to get that first question, as close to right as you can.
Steve Leeson,
Raise your hand,
CNBC.
guys. Next guy in the front
Chairman,
row. Go ahead.
I guess I had assumed that there was a tightening bias in the committee. You say in the statement you're looking to assess the appropriate stance of monetary policy, the extent to which you may need to hike additionally. You didn't say earlier that you were sufficiently restrictive. There were forecasts for 2 rate hikes among most members of the committee. But then you just said that, we haven't made a determination. Would you say the bias right now is neutral, that there is no disposition to hike again, and that the committee largely has moved off of this forecast for 2 hikes? Or for 1 additional hike?
I think you're talking about 1 additional.
Yeah,
No, I wouldn't say that at all. I would say, the language, looking over here.
Sorry, stand by. Dog going nuts. And I'm back. Okay. My 4th kid came home from school, but all right, let's keep going with this.
In determining the extent of additional policy firming that may be appropriate to return inflation 2% over time. That's the question we're asking.
So is it right to think of that as a hiking bias is still in the committee here?
We haven't used that term, but it's fair to say that's the question we're asking is, should we hike more? It's not, and that is the question, and you're right, that in September, we wrote down one additional rate hike, but, and we'll write down another forecast, as you know, in December.
Chris.
Thank you. Chris Rugaber at Associated Press. Well, since the last meeting, the auto workers' strike has finished. Oil prices have leveled off. And yet, on the other hand, you have the outbreak of war between Israel and Hamas. How do you see all those factors taken together affecting the economy going forward? How are you thinking about those?
So there are significant issues out there. As you point out, global geopolitical tensions are certainly elevated, and that goes for the war in Ukraine. It goes for the war between Israel and Hamas. We're monitoring that. Our job is to monitor those things for their economic implications. So the UAW strike, as you point out, appears to be coming to an end. Oil prices have flattened out. They haven't gone down, but I guess they've gone down a little bit from their earlier peak. Another one is the possibility of government shutdown. We don't know about that one. So there's plenty of risk out there. But I would go back to the bigger picture from our standpoint is we've got a very strong economy, strong labor market, making progress on the labor market, making progress on inflation, and we're very focused on getting confident that we have achieved a stance of monetary policy that is sufficiently restrictive. That's really our focus.
Great. And just one quick thing. You last month had gone to York, Pennsylvania, where you talked to last month, where you talked to a lot of small business owners. Just curious, what sentiments did you hear from them, or what did you picked up on, and was there anything that surprised you the most in terms of what they talked about?
I wouldn't say I was terribly surprised. I was very impressed by York as a town with a real strategy, and I would say it's very impressive what the people there have put together in the face of some difficult longer run trends about offshoring of manufacturing and that kind of thing. They've done a great job as a city, I think. What you hear, and is consistent there, which is people are really suffering under high inflation. You were there.
All right, guys, that's it for that. Let me go back, and I want to check out the charts before we head out of here. And so let's start with Bitcoin. 34,622 right now on Bitstamp. This is the hourly chart. Not much happening. No real reaction from this FOMC statement or press conference. Let's check out the dollar. Dollar has been selling off slightly, but if we go to the daily, you can see it's nothing on the daily. It just looks on the 5-minute chart or the hourly chart, looks like it's dipping here a little bit, but still at 106. Let's take a look at gold. Back under $2,000, really struggled to break and stay above the $2,000 mark for gold. Let's check the 10-year. Oh man, this is the one that I've been really watching today closely. I talked about it as well on the Bitcoin Magazine Pro. You guys can sign up for that at bmpro.substack.com. I'll have an article coming out with them today, but I looked at this chart right here with the 10-year breaking down below this previous close from back here just before the Israeli-Hamas conflict kicked off on 6 October, and we are breaking below that support. So we will see if we've put in a top. This is also a bear div here on the daily. I am expecting this to come down. Oil, how did this react? Let's go down to the hourly chart. It has been selling off for most of the day. Really not showing any strength in demand at all on the oil side of the house. This was also what I have been predicting. And lastly, let's go to the stock market. They seem to have liked this press conference from Powell. So it is up just in the last hour. On the daily, it is up over 1% right now on the daily. And as I talked about earlier on my earlier live stream on Telegram, It did gap up Monday, Tuesday, and Wednesday. So this is a pretty strong move here in the stock market. Pretty stronger move, even I would say, than some of these days. So we back on the 6th of October, it moonshotted here in one day, but then it had a gap down and then a gap up. And here we had 4 gap ups in a row. What else we got? Yeah, it just looks like a really strong move here on the S&P 500. So we will be watching that to see where that takes us. One more thing. Let's take a look at, this is CNY. Let me hide my thinker. So this is also going to be pivotal for Bitcoin because Bitcoin is highly correlated with the CNY. When CNY is getting weaker, and on this chart that is going up, as it is getting weaker, Bitcoin struggles. And I went back and I checked this correlation for the last year or two, and it is extremely tight. So if CNY continues to weaken, I think that's going to make Bitcoin's rally throughout the rest of this year harder and harder. I still think Bitcoin will rally, but it will be facing a lot more headwinds if the CNY continues to weaken against the dollar. All right, well, that's going to do it, guys. Thanks for joining me. Ansel Lindner, Bitcoin and Markets. Check out bitcoinandmarkets.com for all my stuff. Check out bmpro.substack.com. I am live streaming on YouTube and Rumble and Telegram. So you guys can find the links to that wherever you're watching this down below. And like, comment, subscribe. That helps me out, helps other people find the show. And that's going to be it, guys. I'll see you on the next one. Bye.